Check Equt app now.
All right, 290 points right now. So it's basically back down again. 16,395 is where we find ourselves at. Rajat Rajgarhia is Managing Director and CEO of Institutional Equities at Motilal Oswal Financial Services. He's with us. Rajat, great to have you with us here. Thanks very much for your time. Just a quick word on markets from here, and if you feel, there is more coming on the way down, or are we kind of somewhere close to making some sort of a bottom with the correction we've seen today? Rajat, I think, yeah.
No, Rajat,
I think we still have a issue. We can't hear you. Let's, okay, I think we'll just fix that. We'll just test it actually on the back end and then go across to Rajat. Let me just quickly take a look at the market, which is down almost back down 300. Okay, I think we have Rajat with us. Tried and tested now this time. Rajat, go on. I think you heard my question. We couldn't hear you, but go on.
Yeah. So Prashant, I think the markets are trying to adjust to what the central bankers across the world are showing us the new color of rates. And we still don't know which way and in what pace the rates move up. So we will keep adjusting to the steps that are being taken. And I must say that in the last 3 months, we have seen the tones and the colors on the central bank policy changes very rapidly. So this is a market which is going to remain volatile. And I think you will see the bias being down only till the time we do not get clarity on what is the sequencing and the extent of hikes that we are going to see next 1 quarter.
okay. Rajat, good afternoon. You saw the last cycle, right? The big rate hike cycle where we had inflation as well, but there was the economic growth as well. And we had the market go up 7-8 times. Of course, the starting valuation is something which is up for debate. But, you tell us, you think after this perhaps initial knee-jerk, we could have something similar play out, or could it be different this time? Your thoughts?
Look, Anuj, the 2 important points last time were that we were at the beginning of the growth cycle and the market valuations were still favorable. Today, while I do agree that at least the growth is going to look better, but the starting valuation is not so cheap for the aggregate markets. We are still at 20 times forward with, I think, more risk of downgrades in the next 6 months. So maybe after some fall, the markets will do well, but I think the pace of the hikes are the one that markets are getting more shocked with. We were all preparing to write a note on FOMC. We didn't know before that we had to write a note on RBI. So that is the kind of time that we are living in. And frankly, I think it was surprised to see how the US markets reacted on the day of the Fed hike, but we saw what happened a day later. So the market is definitely uncomfortable with what signals we are getting from the central bankers.
All right, Rajat, welcome to the show. In a rising interest rate scenario, the belief is that banks initially tend to do well. Do you buy that belief? Do you think that the banks deserve a higher exposure? Because credit growth is expected to pick up. Maybe the worst of asset quality is behind. So will you look at banks? And if yes, would it be the large private sector banks or some of those PSU banks that are offering value? Go ahead.
So the theory is right that in a rising rate, at least in the initial part, banks do well just because of the sheer repricing. But important to note here that across the world, central bankers are trying to curb demand because they are fighting inflation. On one hand, inflation is a result of multiple supply side related issues. But on the other hand, your rate increases are going to impact your demand. And banks, I think more than just an earnings play, they end up being a play on the macro growth story. So the extent of rate hikes that we are seeing, if the intent is to slow down the growth, then I think in that scenario, you may have a case where banks may outperform, but still may not give you returns from here. So I think we have to watch because, RBI doing 40, Fed doing 50, and the markets cheering that it was not 75. I think these are some of the signs which in the next 1 to 2 months will help decide whether we go up or we stay range bound.
What could be the triggers, though, Rajat, for the market to do well from here on, according to you?
Well, first of all, I think this daily tap of FII outflows somewhere need to pause, because if you have a $500 million daily outflows coming from FIIs, whatever money our retail or the domestic funds are pouring in, that's just an offsetting factor, right? So I think that is one. Second, I think right now you would have seen last 24 hours, everyone raised their rate expectations for the next 6 months. You know, the 10-year is at 7.5, almost 7.5, right? It is important to see that if rates cross 8% anytime, what becomes the tendency at the margin of the money to flow between debt and equity. I would think that the best case scenario is that we will remain range bound here and then wait for the earnings to not see any major downgrades over the next 1 quarter.
Rajat, since you touched upon the topic of flows and $500 million of outflow on a daily basis almost, and we are averaging 40,000 crores of selling since November of last year. Are you concerned that with the recent sort of this mutual fund episode, though we don't know the scale of that, if domestic investors also start to redeem, then that could put a bit of a systemic risk for the market? We've already seen some of that play out today in a lot of individual names. I mean, look at names like Cholamandalam. Despite good earnings, the stock's down 12%.
Well, Anuj, the market sentiment typically is right now colored by many factors, right? And we are seeing this at a global level. So fall in stocks could be attributed to multiple factors. But I think what is important is that the companies where the valuations do not provide any margin of safety, they typically will take the brunt in a rising rate environment. Secondly, from the retail investors' point of view, I don't see any challenge to the flows, at least for now. But as I said, at the margin, we have lived into the last few years or many years of low rates. That played a very big role in the shift of money to equities, right? I would think that for the next 50, 75 basis points, we are still comfortable. But if the global rate cycle and in turn the Indian rate cycle were to move any further from here, we just may need to be watchful of what kind of flows from the domestic savings pool we see. I think offshore pool will remain volatile or negative for some time because there are many other factors driving that. In India, the key factor will be at the margin, how do people feel comfortable about the markets?
All right, Rajat, very, very quickly, in times of uncertainty, you normally see money move towards pharma or IT. IT stocks, they already run up and they've already corrected a fair bit, though valuation-wise as well, they don't look very, very cheap. Your take on both these two sectors post the correction? Will you give IT a second look and also pharma stocks?
Well, I think IT as a sector has generally been an evergreen sector, but just that the last 2 years, the sector has seen big re-rating, right from the large caps and more into the mid caps. I think a lot of the valuation correction, either by time or by some price falls, are bound to happen. Some of that has already happened. So I think at best right now, you will see IT more like a parking space and less of an absolute return space. Pharma always has been a very bottom-up story. There is no sectoral call that one can take because there are multiple plays to play into pharma. But I would still think that rather than taking sectoral view, it is best to assess wherever you get still a stable earnings and a more reasonable valuation. I think 2020, 2021, we lived through where buy growth at any price. Right now, we are looking at buy stable growth at reasonable price. Balance these two things, you will still get at least half a dozen plus stocks within the large caps to invest through.
Okay, Rajat, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always. And we do hope that you come oftener. I think you joined us after a long break. Let's move on then. Mixed show from Canara Bank in the fourth quarter as slippages are elevated and loan growth momentum remains weak.